Welcome to HYCM Insight with myself, Giles Cochran. Now, the market move for the session ahead is as follows. The Reserve Bank of New Zealand has a record high employment data and inflation pressures. The third quarter inflation has risen at its fastest pace in 10 years, annual inflation rate moving up to 4.9% from 3.3% in the second quarter. The unemployment rate is down to near record lows at 3.4%, employment up 2%, and the participation rate higher too for New Zealand. All of this has led Westpac to recently expect the RBNZ to move interest rates up to 3% in 2023, and ANZ are forecasting the RBNZ to raise interest rates to 2%, a neutral rate by the end of 2022. This does mean there is still a clear buy bias for the New Zealand dollar. The Japanese yen, by contrast, has seen a huge fall because it's the one central bank that's really not expected to respond to surging inflation by raising interest rates. This does mean there is a large divergence between the RBNZ and the Bank of Japan. Check out the strong seasonals too. Over the last 10 years, New Zealand dollar Japanese yen has risen 80% of the time between November the 10th and December the 31st, an average return of 3.42%. Largest gain here in 2012 with a 10.56% rise. Largest loss was in 2018, where New Zealand dollar Japanese yen registered a minus 3.61% loss. And now also just taking a look at the New Zealand dollar Japanese yen chart, we can see that price is just moving down into that key support level, which would be an acceptable level to expect buyers, and you would expect to find some kind of support at that level. Now, major trade risks. If there was a sharp change in the outlook for New Zealand, this could alter the outlook for the New Zealand dollar Japanese yen pair over the few following weeks.